Figures released today show Norway's economic growth accelerated to 0.7% in the first quarter, but overall GDP fell 0.2% from 0.3%. Chief strategist for Norway, Blomgren at SEB, joins me on the line. Erica, what do you make of these figures?
Well, I think mainland GDP, that excludes oil, gas and shipping, was broadly as expected, and I will not make too much out of the deviation. I think the most important factor is that the rebound in private consumption was very strong after a very weak fourth quarter. And I would say spending is now more in line with what fundamentals in the household sector would suggest. Also, residential investments and somewhat surprisingly exports of traditional goods help to lift mainland GDP. So undoubtedly, I would say the peak has been passed in terms of acceleration in growth, but the mainland economy should still settle at a trend-like growth going forward. And in terms of the overall GDP, it was a disappointment, but it was partly due to a sharp drop in exports of oil and gas. And this was expected as there's been production problems at a number of fields in the first quarter. But the other part was the very volatile inventories component that dragged down overall GDP by almost a full percentage point. So looking ahead, I think exports should recover and investments in the oil sector remains high. But on the face of it, it does suggest that the overall GDP growth will be somewhat lower than the 2.5% we had expected for this year.
Norway is apparently raiding its oil fund for a record sum of money as its centre-left government looks to prop up the economy. Only 4 months before parliamentary elections, it is expected to lose. What are your thoughts on this?
Well, the spring budget does seem more expansionary than the original budget for 2013, but I would say the stronger fiscal stimulus is just as much a reaction to the revisions of the outcome in the last year. So I wouldn't say that the government is really spending even more oil money to boost its chances for winning the general election. Real spending growth and fiscal stimulus will be broadly the same as in 2012. So it's, of course, the general budget surplus is estimated a tad lower now. It's 11% of GDP. That is some 25 billion kronor lower than assumed in the original budget. But the main reason for this is lower net cash flow from the oil sector, of course reflecting that the forecast for oil and gas production has been revised lower. So from a fiscal perspective, I think there's not so much change, and also that the fiscal soundness of Norway still remains very, very strong.
On the surface, Norway is the envy of the world. Growth is strong. Per capita GDP has exceeded $100,000 and the nation sits on a $700 billion rainy day cash reserve. But it may just be too much money as Norwegians, more keen on leisure and family life, are working less and less. Could this be a dangerous spiral if and when bad times hit?
Well, both yes and no. There was a strategic decision a long time ago to allocate resources into the oil industry where you had the best return. And I'd say since then, Norway has, of course, experienced an income boom, and parts of that also welters over into higher wages for workers. The negative effect of this is the relatively high labor cost, which has caused the traditional industry to become less competitive. But in the long run, I'd say the spending of oil money, as stipulated via the fiscal policy rule, has a stimulative bias. And I believe that to avoid the scenario discussion, I would say that spending needs to be better controlled going forward to avoid overheating the economy and of course, to avoid too high wage growth.
There are also concerns the oil sector, the source of the problem, is also becoming a victim of its own success. A study commissioned by the government showed that by 2016, the country will have a shortage of 6,000 engineers as oil investment hit new records and oil firms tap reserves in areas once thought close to depleted. Costs have risen so much, some oil services firms cannot compete at home. Do you think going forward Norway needs to rely less on oil to feed economic growth and focus on alternatives?
I'd say that Norway has become even more reliant on oil over the past years, and it just shows that the ongoing strong investments in the oil sector is really feeding into the economy in terms of domestic demand as well. Of course, a lot of supply to the oil sector, but it's definitely less affected from an economic perspective, at least by what's going on abroad and especially in the Eurozone. Of course, there is alternative investments as well, and not only focusing on oil. But overall, there is for sure a capacity problem in the oil sector. I mean, investment plans among companies operating in the Northern Sea are not fulfilled within planned time as there's a shortage of skilled labor. So, but for me, it just means that the investment cycle will run for longer. Nevertheless, the high cost level, as you mentioned, is a problem, as many of the new projects have been awarded abroad. And this will have to be adjusted in the future for Norwegian companies to remain competitive. On the other hand, I'm not too concerned with the oil dependence of the economy, but it's important that Norway avoid creating a Dutch disease and hence preserve the manufacturing sector as well, even though it's only a small part of the economy today.
That's all for now, but do check out my interview covering US data releases today. Goodbye for now.